The world economy is gradually pulling out of the crisis, but it's an uneven recovery. It's stronger in some regions, such as the United States, weaker in others, particularly in Europe. At the OECD, Carlo Padoan is the Chief Economist and Deputy Secretary General. He has an unparalleled overview of the challenges facing governments as they try to coordinate their policies in order to pull out of this crisis. Carlo Padoan, thank you for joining us at INSEAD Knowledge. Can you give us your thoughts about the state of the world economy as we enter the summer, and where are we heading?
Well, growth is coming back with different speeds, certainly with a higher speed in the United States, much less so in Europe, and half and half, I would say, in Japan, with some growth also resuming at different speeds in the emerging economies group. But I think the point is different. The point is not so much different speeds, but why is that some countries are finally possibly exiting the crisis, others are still struggling with the crisis. We identify 2 points. One point is that countries where there's more progress, and this includes the United States, but also countries like Canada and Australia, are the ones where either the financial system has not been touched by a financial crisis, or where the financial system has been repaired soon, early on in the crisis. This is the case of the United States. This is not the case of Japan, and it's not the case of the euro area. The other thing is about confidence, meaning by that this private sector will begin to believe in a sustainable growth environment, and therefore will begin to spend, including long-term consumption, including especially investment, once it is convinced that the policymakers have the situation more or less under control, which implies that the policymakers must demonstrate that they have a long-term, medium-term, long-term strategy. And this also comes in different degrees in the different parts of the world. Some countries have a clear long-term strategy, others still struggling to get it on board.
You have been warning for years about the imbalances that are affecting the global economy. Are we approaching the point where these imbalances may be beginning to be corrected?
The global situation itself is changing. Yes, imbalances are still there. Actually, they have stopped declining because we are exiting out of the recession. In the euro area, they are shrinking, also because of gains in competitiveness in the south part of the monetary union. But there are new imbalances, and those are related to the huge amount of liquidity which has been poured into the system by central banks, which rightly so have poured liquidity to support demand in the global economy. However, this huge amount of liquidity is now looking for yield, and it's looking for assets everywhere, so that even assets that in more normal times would be considered as too risky are being bought by investors. And so the result is that you see yields in high risk, what were once high risk assets now being very low. The issue there is not so much that we have huge liquidity. The issue is that at some stage monetary policy will have to slow down its pace and eventually begin to think about exit. I'm very cautious in using my words because this is going to be a very delicate operation, and we simply do not know how markets will react to a reversal of the monetary policy stance.
So when should the exit process begin? Surely it's too early as yet.
Of course, that depends very much on where you are. In some cases, in the case of the US most notably, the so-called forward guidance by the Fed is beginning to clarify what the Fed will be looking at in terms of variables that will suggest an exit. And these variables are inflationary expectations and unemployment. So if unemployment goes down, there's less of a need of an expansion. If inflationary expectations go up, there is rather the need to keep those expectations under control. We are much more behind that situation in Japan, where actually aggressive quantitative easing is starting just now. And of course, we are much less there in the euro area, where actually we think that the ECB could do more, not just in terms of interest rates, but also in terms of more aggressive forms of what I would call a Euro-style QE, a Euro-style quantitative easing, buying assets in a number of possible alternative ways.
Is that an admission that the past policies of austerity and fiscal consolidation were perhaps excessive or a little bit misguided in some ways?
Fiscal policy, of course, is the controversial issue. First of all, let me tell you one thing, which the public sometimes neglects. If you look at the fiscal policy stance over the recent past, in the US and in the euro area, you will see hardly any difference. It's not true that we have more fiscal expansion in the US than we have in the euro area. Actually, they're the same. And we say that in the US there is excessive fiscal tightening indeed, also given the sequestration. In the euro area, the story is a bit different. If you look at consolidation needs, meaning what is needed for debt levels to stabilize and eventually go down, well, most of the European countries have already done their homework. We are there. And very soon, in a matter of a year or a bit more, we will see if growth persists the way we forecast. We will see debt levels decline, which means this is a turnaround. It's adjustment paying off. On the other hand, there are countries, Japan, the US, and the UK, where the consolidation needs are still very large. Yes, of course, fiscal consolidation weighs negatively on demand. We all know that. But in that case, the recommendation is to adjust the pace of consolidation, to let automatic stabilizers operate, and last but not least, try to improve the composition of consolidation. You can achieve the same fiscal results with very different policy mixes, which have very different impacts on growth and equity. So there are ways to improve very much the fiscal stance across the board.
So where should we be looking for growth now?
We should be looking for growth in a number of ways. This, I think, is the real tough question for advanced economies. Emerging economies grow because they catch up to the frontier, and this is why they grow more. But countries on the frontier have to push the frontier, and we know how that happens. Innovation, knowledge-based capital, and of course structural measures to make markets work better. On knowledge-based capital and assets, let me draw the attention to the fact that now there is growing evidence that these investments in knowledge are responsible for most of the productivity gains in an economy like the United States. So this is one major way forward, to look for new sources of growth, including in green innovation, for instance.
And geographically?
Well, geographically, we will see more growth in the US than I would say in Europe. Europe, as we all know, a structural low growth problem, which requires an additional dimension, which is more integration. Speaking of the single market may sound old-fashioned, but it is not, because most of the single market gains can still be reaped, for instance, through liberalization in services, which, as we all know, is about 70% of GDP on average.
How does this tie in with the project that you're working on at the OECD on new approaches to economic challenges?
This project tries to take stock of the lesson from the crisis. Of course, it tries to take stock on the interaction between the financial sector and the real economy, and there we need to understand better how is it that financial instability builds in endogenously to the system. But there are other dimensions. One dimension is that, one lesson I would say, is that you cannot look at growth alone in the future. You have to ask the question, what are the key dimensions that make progress in an economy, in a society? Certainly GDP growth, but also inequality, fighting poverty, making sustainable environmental development possible, and so forth. This is not new. What is new is the recognition that policies have an impact on all these dimensions. Let me give you an example. If you have a policy which enhances growth, for instance by injecting more competition in product markets, then you have more growth, and this is what you would expect, but then you have consequences for inequality, for the distribution of wealth. You have consequences for pressure on resources. So you have to take on board all of these dimensions once you design a policy strategy. This is, after all, what a government is about. It's not just the finance minister, it's also the employment minister, it's also the welfare minister and the environment minister that have to agree on a strategy. And what the OECD will try to do is to provide as much information as possible to governments so that they better understand the interconnectedness between different policy areas, the trade-offs and the complementarities. Now there is a new emphasis, which I think is very welcome, on trying to link better the fiscal side with the employment side. How can you design fiscal consolidation and employment policies in a unified way so that where there is high unemployment, you can hopefully achieve both a sound public finance situation, but also you create jobs. These are the job agenda, I hope, will make progress in the G20. I think it's extremely important that it does.
Which country wins the prize for structural reform so far?
The country that comes immediately to mind is Germany, because one of the reasons why Germany, in spite of the crisis, is doing so well is exactly that they have implemented reforms before the crisis. So this is why they say that their model is important. I'm not saying that we should all be Germany. I'm saying that we tend to forget that this is one of the secrets of German success.
But Germany is also posing problems for the euro area in terms of its excessively high balance of payments surplus.
Germany has a very strong manufacturing sector. It has a much less strong, actually weak and non-competitive service sector, which is not exposed to international competition. So we recommend Germany to open up that sector, the so-called non-tradable sector, which would boost investment and therefore would reduce the surplus, the current account surplus, but also would boost growth. So this would benefit Germany in the first place, but also the rest of the euro area.
How do you see prospects for China?
Well, China is explicitly undergoing a major structural adjustment process. Actually, the challenge that they have taken up is to adjust the composition of domestic demand towards more consumption, less investment. This, of course, is a huge challenge, which implies redistribution of income between income classes, but also between the countryside and the cities. They intend to do so trying to be more respectful of the environment, so this means changing the energy mix, and they intend to do so in a private sector-led way, which implies building up a financial system which hopefully does little in terms of instability and does a lot in terms of growth financing. So certainly there is a huge structural reform agenda in China going on.
So on balance, would you say that China is fitting in well with the overall strategies that need to be put in place in the global economy?
They are such a huge country and diverse country that certainly everybody can do better, but I continue to consider their effort as impressive because they, perhaps this relates to their political culture in a way, they have a clear view of all the interconnections. Such a big country with huge transformation challenges has to have a strategy, and this in these cases helps, especially if this strategy has to be market compatible. It is not a command economy we're talking about, it's an economy which is more and more market driven.
A year from now, looking ahead, what do you see for the world economy?
Let me give you my preferred option. We will stand in a situation where the US economy will have further strengthened its position, where hopefully progress would have been made in the euro area in institutional adjustment, including the banking union, and at the same time some positive growth coming back all over the euro area, at least in most of it, with unemployment beginning to go down. This may not sound extremely exciting, but I would subscribe to that today. Also because, especially in the euro area, risks are still very large, and we cannot rule out what economists call multiple equilibria, meaning rather than going forward, going backward in terms of more debt accumulation and more weak activity, including the risk of stagnation.
Doesn't that sound very much like the situation in which Spain and Italy and Greece and Portugal are caught today?
If things do not change, we are moving towards what now I would call a good equilibrium, because debt would start to decline. So I'm saying this is my preferred outcome. Having said that, if some things go wrong, we could also always fall back into the bad equilibrium. So let's be very vigilant.
Thank you very much, Pier Carlo Padoan, for joining us at INSEAD Knowledge.
Thank you.